I hope you have your aspirin handy, because this video is going to be a real mind bender. But what I'm going to do is I'm going to present to you real evidence that not only does the Federal Reserve treat gold as money, but they're actively using it in their existing monetary system. Early in 2016, I started a video series titled Architects. It's been a while since I started that series, and it's time to get back to it and extend it. In the opening video, where I focused on Reagan's Gold Commission, I mused about these particular gold coins and why the various governments of the world would create them. It seemed odd that sovereign nations who are reportedly desirous to prevent their citizens from saving their wealth outside of the banking system would provide an ideal means of doing so through the sale of officially minted gold bullion coins. What I concluded after a lot of background research was that, at least in the US, the law put on the books to authorize the Treasury to produce gold bullion coins was very carefully considered, and the details took years to work out. It was not the action of a government who was hostile to gold. Quite the contrary. In fact, one of the key debates among the architects of the Gold Eagle program was whether or not to recommend the introduction of a gold-backed Treasury bond. Proponents of the gold-backed bond thought this would be an ideal way to reintroduce gold into the monetary system and impose some discipline on government spending. The detractors had a much better argument. They stated that introducing a gold-backed bond would provide a risk-free and cost-free means of taking delivery of gold in the future and would also provide an interest rate sweetener. Thus, having a gold-backed Treasury bond would reduce the attractiveness to the population of owning real physical gold. In other words, the architects wanted the citizenry to own real, physical, unencumbered gold as a means of wealth storage. This is just one of the many examples that I uncovered of how the architects viewed the proper functioning of gold as a parallel monetary system. Now, I highly recommend that anybody who has not watched parts 1 and 2 of my Architects series take some time to do so before watching this video. The background presented there will be important to understand the material that I will be presenting here, but I will still summarize that material at a very high level, just so that this video will make some sense all on its own. And I will start this video with a new question. This question is similar to the question about why a government hostile towards gold would pass a law which provided an ideal and a low-cost way for its citizens to own gold. This question is about a law passed 52 years ago. Here is the law in question. It was passed in 1965 during the Lyndon Johnson administration, the same year that silver coinage disappeared from circulation. What it did was repeal the requirement that the Federal Reserve hold a certain quantity of gold certificates as a reserve against its outstanding liabilities. In other words, up until this point in time, the Federal Reserve was constrained in the amount of Federal Reserve notes that it could create by the book value of the gold certificates that it had on account. But more about gold certificates in a moment. This was a very important law. In fact, it was just as important an event as Nixon's closing of the gold window in 1971. But more important than what this law did do was what it did not do. Notice that although it gave the Federal Reserve permission to expand its liabilities without regard to the gold coverage, it did not eliminate the use of the gold certificate. Think about that for a moment. For the past 52 years, the gold certificate, a pivotal component of the Gold Reserve Act of 1934, has remained part of the U.S. legal code, despite this new 1965 law reducing the Federal Reserve requirement to zero. For the past 52 years, the first lines of the Federal Reserve's balance sheet have listed its gold certificate account balance. So my question is this. If gold is not a critical monetary asset, then why are gold certificates still part of the U.S. legal code, and still the first entry on the Federal Reserve balance sheet? I'll give you an answer in a little bit. First, let's start with a brief reminder of what actually happened in 1934 with the passage of the Gold Reserve Act. Recall that one of the events in the 1930s which nearly led to the demise of the banking system was a banking panic. The banking system used as a reserve specie, which was the name given at the time to physical gold. The banking system had issued so many paper claims against its specie that people lost confidence in the safety of their deposits, and so they started to redeem their currency en masse to protect their gold. The system was already insolvent, but the loss of confidence meant that those who were in the front of the line would remain whole, while others would be left with nothing. Roosevelt and Congress responded by shutting down the banking system and reorganizing it. In other words, everyone was made to share the loss rather than being borne solely by those who were late to the bank window. The Gold Reserve Act, shown here, relieved the banking system of all of the gold that it had as reserves and transferred ownership to the Treasury. In return, the Treasury issued to the Federal Reserve gold certificates, which were liabilities representing an obligation at some point which were payable in gold. In addition, it put restrictions on the Federal Reserve in terms of currency issuance. The Federal Reserve was required that the book value of their gold certificate account never fall below 40% of the Federal Reserve notes in circulation. It was essentially the U.S. government taking custody of the gold for safekeeping because the banking system had been so irresponsible with it. So let's now focus on these gold certificates. As mentioned previously, they still exist and are on the books of the Treasury and Federal Reserve. It's important to understand them because, after all, why would they still be carried on the books if they have no significance and will never be used again? Why would the government not simply do away with them? Why are they still the first entries on the Federal Reserve balance sheet? Gold certificates are liabilities of the Treasury. They represent the gold used as collateral for the banking system. Yes, you heard that right. There is an obligation still on the books of the U.S. legal code, and thus the gold is technically still collateral against the Federal Reserve note. The value of these certificates on the books of both the Treasury and the Federal Reserve is $42.22 per fine troy ounce. The actual value is obviously much higher, but it hasn't been updated for decades. Unlike the system adopted by the European Central Bank, the U.S. government is not marking their gold assets to market. Another thing which I will highlight in a moment is that 100% of the U.S. gold has been monetized in this fashion. Think of the gold as an encumbered asset. It's like owning a home that has a mortgage on it. If you have a mortgage against the home, you still technically have title to the home, but you can't sell it without discharging the debt obligation first. So it is with the U.S. The U.S. retains title to its gold, but the gold is 100% encumbered. It is not legally allowed to sell the gold first without retiring the gold certificates that it's issued against it. The Treasury is also not permitted to issue additional gold certificates without acquiring new gold or raising the price of the existing gold certificates. This is the way of ensuring that the Treasury is not allowed to dilute the value of the existing gold certificate liabilities. Finally, the Federal Reserve cannot require the Treasury to retire its gold certificate obligations by transferring gold to the Federal Reserve. So technically, there is still gold backing to the currency, but it is only in the form of an encumbrance. The gold certificates are just like a non-callable, infinite-duration mortgage on the U.S. Treasury gold. The Federal Reserve notes are issued with the gold certificates used as collateral. And you can see here the matching liabilities of the Treasury with the assets of the Federal Reserve. On the balance sheet of the Treasury, it shows $11.04 billion worth of gold on the asset register. This represents 261.5 million troy ounces with a book value of $42.22 per fine troy ounce. On the balance sheet of the Federal Reserve, it shows $11.037 billion worth of gold on the asset register as gold certificates. At a book value of $42.22 per ounce, this is 261.4 million troy ounces. The difference is probably a rounding error, since the precise book value actually goes out to the fourth decimal place. But why quibble over such a small difference? What's fascinating to me is that as much as the Federal Reserve fails to acknowledge the importance of gold to the general public, their balance sheet reports going back to 1934 all the way through to the current day have always listed gold certificates as their top line asset. Now, why is this important? If we consider accounting standards, balance sheets are always ordered from the most liquid to the least liquid item. By liquidity, we mean the rapidity with which an asset can be converted to cash, and the relative losses incurred between going back and forth between cash and the asset are small. Thus, if an asset can be converted back and forth to cash quickly and with minimal losses, it's considered liquid. And look, even in 2016, the Federal Reserve reports Treasury gold certificates on the top line of its balance sheet. Next are IMF special drawing rights, or SDRs. So if we go by general accounting standards, it means that the Federal Reserve believes gold certificates and SDRs are more liquid than even Treasury bills, notes, and bonds. But here's the problem. How do we know for sure that this is the case? After all, the quantity of gold certificates on the balance sheet of the Fed didn't change from 2015 to 2016. In fact, the quantity of gold certificates has not changed appreciably since the year 1980. If these gold certificates are liquid, how will we know? Evidence of liquidity is lacking without evidence of transfer of ownership. Are these Treasury gold certificates transferable? Or are they just a historic artifact that is shown on the balance sheet for reasons of, as Ben Bernanke would say, tradition? Well, I have the answer. And this, to me, is quite incredible in its implications. Let me show you what I found. Stare at this slide for a moment and see if you can notice something interesting. If you said that the gold certificates are moving from bank to bank, then pat yourself on the back. This is incredibly important. Each of the 12 regional banks is independently incorporated with their own boards, and gold certificates are moving from bank to bank. This is evidence that the gold certificates are being transferred in terms of legal ownership. So gold certificates are not only liquid, but they are being used as money. Why else would title to them need to be transferred? Still, they are not leaving the overall Federal Reserve bank network. This means that they must be vitally important. Let's see what has happened to the flow of them into and out of the system throughout history. Here is a plot of Treasury gold holdings from 1915 through the present. On top of this plot, I have placed as red dots the number of ounces of Treasury gold represented by gold certificates held by the Federal Reserve. To determine the quantity, I looked up the annual reports of the Federal Reserve in 5-year increments and divided their reported dollar value of gold certificates by the official book value at that time. I didn't have time to look through each and every yearly report, so we'll just have to use 5-year increments. I also started the gold certificate plot in the pivotal year 1934, because that's the year when all the Federal Reserve gold was transferred to the Treasury and replaced with gold certificates, which represent claims on the gold. We can see that at least for the first 30 years or so, the Treasury held some gold in excess of what was encumbered by gold certificates. And then between the years 1965 and 1970, the percentage of gold that was encumbered gradually increased until virtually all of it was encumbered. We can also see that between the years 1934 to 1944, gold flowed into the U.S. Part of this was because the U.S. was supplying wartime goods and services to allies in Europe. Part of it was due to sovereign nations in Europe wanting to safeguard their gold against possible ransacking by Adolf Hitler. After the war, for a period of about 10 to 15 years, the level of gold in the Treasury remained fairly stable. But then, starting around the year 1955, gold started to flow back out of the Treasury. While $35 per ounce of gold appeared to be an attractive price to the countries looking to safeguard their gold, it did not look so attractive once World War II ended and the Korean War, Cold War, and space race commenced. Some important dates to consider are shown on the graph. In 1934, the Gold Reserve Act was passed. As we discussed, the Treasury took custody of all the gold and replaced it on the Federal Reserve's books as gold certificates, and required the Federal Reserve to maintain a reserve of at least 40% gold certificates against its liabilities. Later in that year, the statutory price of gold was increased from $20.67 per ounce to $35 per ounce, which paved the way for the Federal Reserve to increase the currency supply. 1944 marked the year that the gold standard was changed to the gold exchange standard in Bretton Woods. This system used Federal Reserve notes as the world reserve currency, backed by gold held by the U.S. Treasury. Foreign entities could exchange their Federal Reserve notes for gold, but did not have a good reason to do so yet. In 1945, the gold cover was reduced from 40% to 25%, enabling the Federal Reserve to expand its obligations even further. This was an odd move, and one that I'm still trying to understand, because the Federal Reserve maintained a 40% cover up until about 1960. As gold drained out of the Treasury and Federal Reserve due to withdrawals by foreign entities, the Fed entered a period of time when it was not able to maintain a 5% cover. The government responded in 1965 by removing the cover altogether. It did not stem the flow of gold out of the Treasury, surprise, surprise, but did at least make it possible for the Fed to be in compliance with the law. It wasn't until Nixon closed the gold window in 1971 that the bleeding stopped. This is when the Treasury gold and quantity of gold certificates in the banking system more or less stopped dropping. Now, let's see how the nominal balance sheet of the Fed looked over this time frame. Now, I'm plotting this graph on a logarithmic scale because if I used an arithmetic scale, the nominal value of the gold certificate account would be barely visible. For those of you unfamiliar with logarithmic charts, it's simply a way of scaling an axis so that a fixed distance along the axis represents a fixed amount of percentage change. Thus, a move from 10 to 100, a tenfold change, is the same distance as a move from 100 to 1,000, another tenfold change. The blue trace on this chart is the statutory value of the gold certificate account of the Federal Reserve. Notice it has roughly the same shape as the plot of the gold reserves on the previous graph, because the statutory price only roughly doubled over the entire time frame. By contrast, the red trace representing the Federal Reserve liabilities grew continuously over the nearly 1 century of this graph. If we were to draw a line through the trace of liabilities, we would conclude that the liabilities on the Federal Reserve balance sheet have increased by about 8% per year in nominal terms. The gold backing for this rate of growth, at least at an officially set price, couldn't keep up. Over time, the gold was withdrawn from the system, similar to what happened during the banking panic of the early 1930s, only on a much larger and international scale. The removal of the gold cover in 1965 was a response to allow Fed credit to keep growing, and then the closing of the gold window in 1971 was a response to stop the further withdrawal of gold. All throughout this time, we can see that the gap between the book value of the gold and the value of the liabilities grew. In fact, what started as a 60% reserve in 1934 has now been reduced to only 1/4%. If gold was still the premier reserve asset, then according to this, the Fed would be in big trouble. But don't forget, the statutory price of gold is still $42.22, even though the market value of the gold has increased to more than $1,200 per ounce at the time that this video is being produced. So let's take a look at what it would look like if the government marked gold to market for accounting purposes. This new trace added to the plot is the quantity of gold represented by the gold certificates marked to average yearly market spot price for gold. As can be seen, this new trace is right on top of the blue trace up until 1971. This is because prior to 1971, the government fixed the value of its gold in terms of the Federal Reserve note. The fixed ratio for convertibility purposes resulted in a bleeding of gold from the Treasury as market forces dictated that gold was worth more than the government said it was worth. Then in 1971, the rules completely changed. The gold stopped flowing out of the Treasury, and it caused a fairly strong increase in its market price vis-a-vis the Federal Reserve note as Federal Reserve liabilities continued to grow. The mechanism that held the balance sheet in check pre-1971 was the flow of gold. The mechanism that dominated afterwards was a market revaluation of the Federal Reserve note as reflected by an increase in the price of gold. We can see what this means in times of severe loss of confidence in the Federal Reserve note. The market value of gold certificates in 1980 was sufficiently high that the U.S. could have gone to a 100% backed currency system if it had chosen to do so. But it didn't. Yet the evidence supports the fact that gold is still considered vitally important by the architects of the current monetary system. So what can we reasonably infer from all of this information? For starters, we can see that gold is still treated, if not acknowledged, as an important part of the monetary system. We have gold certificates which still exist and are listed on the top line of the Federal Reserve balance sheet. They are transferred back and forth between independently incorporated member regional banks of the Federal Reserve System, and they act as collateral against their obligations. They haven't left the overall Federal Reserve System for at least 30 years. So, although they are used as money within the system, it's money that is so highly valued that it's not permitted to leave the system. We know that the Treasury is not permitted by law to sell additional gold without retiring some gold certificates, and thus the gold certificates represent an active lien on the Treasury gold, much like a mortgage is a lien against your house. The lien is what gives the gold certificates their value. We also know that by law the gold certificates cannot be redeemed directly for gold. So similarly to the mortgage on your house, the bank cannot just choose to call in the loan arbitrarily. Treasury has control of the gold and can use it to settle obligations, but it can do so according to its own timetable. We also know from part 1 of this series that the government has gone out of its way to encourage the private ownership of physical gold. As evidence, we have a very carefully considered and worded Bullion Coin Act that makes low-premium bullion coins available to those who choose to buy them. We also have a full report of the Gold Commission recommendations, including such recommendations as not creating gold-backed bonds, so that those who wish to own gold will be more inclined to buy physical gold instead of speculating in paper. Now granted, the futures market makes a mockery of this, but at least there is documented evidence that some in the government had the desire to encourage physical gold ownership. And so we know that private citizens are offered their choice of what to use for their savings. They are free to use Federal Reserve notes in the banking system, and they are also free to buy and hold gold. But the gold and the debt are kept separate. We've also seen that the nature of the gold cover has changed. Gold is still active in the system, but the way it is used is completely the opposite of what it used to be. Whereas before 1971, the price of gold was controlled, and the flow was what was used to keep the Federal Reserve balance sheet in check. Now, it's the flow of gold which is controlled, and the Federal Reserve balance sheet is kept in check by the market dictating the value of the gold asset. In other words, the Federal Reserve note's value is changed on the market when the Fed's balance sheet becomes too out of whack. Thus, the Federal Reserve note now represents an indirect claim on an arbitrary quantity of physical gold. And that is really what prevents the ultimate bank run. Wow, I can see that this video has grown quite long, so I better stop it here. But hopefully I've given you all some things to chew on for a little while, and I really look forward to your comments on this one.